Hello, ladies and gentlemen, and welcome back to a special weekend edition of our Markets Around the World coverage. We've got a big one moving forward because as we've seen, we've now got 3 weeks of rejections, wick on wick on wick for the biggest market in the world, the S&P 500. But is it really just the S&P 500 we should be following? Well, of course, today we're talking about Tesla, Apple, some of the big stocks and commodities and even cryptos around the world. But more importantly, we need to see how the bonds market closed for the last week. Bonds are telling us something very different from what the stock market storyline has been throughout 2023. Let's get into it. Well, welcome back everyone to the Daily Show where we talk about markets around the world. We'll be discussing macro, lead news, indicators, and of course the key levels, including the options expected moves for the week ahead. But let's begin with some big discussions about bonds markets and of course money flow. Smart money versus dumb money. What's going on? Well, it turns out that there's a big divergence over the last 1.5 months between what dumb money is doing, which is buying huge, and smart money, which is reducing their purchases. When these similar things happened in 2022, it led to a decline. It is not a necessary timing tool, but it is a point where we should start to think about potential turnarounds and, more importantly, the risk versus the reward in markets. That's always something we should be considering. Sentiment reversed. So we've gone from being incredibly pessimistic in surveys as retail traders and investors to incredible optimism. We've seen this in so many markets, whether it's used cars in January into February or watches or even houses. Everything's come off the bottom, including stocks. But when we go from a negative 10 or under 10 reading to a positive 80, does that mean that markets tend to return well when we've had that reading? Well, the answer is not really. Basically, we go into a multi-month potential kangaroo. Long term, it's usually been positive, that is 12 months. But short term, it's been all over the place. And this brings us to one of the biggest discussions that we can have today. Are we heading for a decline over the next coming weeks and months because of some of these hugely optimistic runs that we've had? Well, one of the ones that I always look at has to be bonds. Here we've got 10-year bond yield, and we've just seen a nice score in terms of the trend model for the 10-year bond yield. That's telling us that there's higher yields to come, and a significant percentage of the time when we've seen these readings, we tend to go up. Now, if we go up with bond yields, what does that mean for all of our favorite tech stocks? Well, theoretically, they should go down. They are very sensitive to increased rates. So this could be the pullback that allows things like mutual funds to potentially purchase back into the market if we are going into a bullish rally. So bond yields are one of our first indicators to tell us that the next couple of months could be a little shaky. In fact, it's really a statistical percentage of the time that we tend to see a rise in yield. And that seems to work with things like what the Fed's been saying, what Bullard's been saying, which is higher yields for longer, and potentially even terminal rates are now being discussed at 6% plus. Now, I'm saying this right now. If we get above 6% in the US in the Federal Reserve terminal interest rate, that's the highest it's going to go. I don't think that's going to work out for stocks, and it's certainly not going to, it's going to break something in the system, at least. That's what I've always theorized. Above 5.5 to 6 for too long, bad things will end up coming. Let's discuss bond risk levels. Now, they've switched as well down to these negative lows here. When we've seen those in 2022, it was an early warning sign that markets would decline. Now, again, it doesn't mean it's going to happen tomorrow, but when the bonds market and the stocks market disagrees, I know who to trust, and it's generally not the stock guys. Stock guys, all we want out there as investors and traders is more money. We work on greed, we work on fear. We want to sell it all down and buy it all up and basically just make profit. So it's a profit mechanism. Bonds markets work on also discussing the risks in the economy or that particular instrument or stock or what company or whatever. So should we be concerned? Well, we're at the point where we should basically be thinking about these things. We've discussed this a lot. 70 years of data. The worst time to own the market in February has been the middle of the month to the end of the month. That's where we've tended to see those declines. It's a real thing. Seasonality does tend to play out. Does this work into some of the other things that we've got going on? Well, we know that yields have also spiked recently, but more importantly, the amount of cuts that the market was expecting to support these new increased asset prices is not occurring anymore. Here's our run from the 16th of February, and you can see that the cuts are nowhere near as significant as they were during some of the big bull run that happened through January. What happens in the future is generally what the stock market trades on. So always remember the stocks trade on kind of like 12 to 18 months off in the future, which is why we use things such as forward PE. And of course, we also use forward trading indicators to figure out what the market is probably trying to price in. Speaking of other things to do with the Q1 and the data that we're in at the moment, throughout the middle of Feb, we tend to see the VIX rising because of these new options expirations, the new one-dayers. We may not see the VIX spike as much as it used to, but it is a seasonal period. Q1 and Q3 are when you need to be most cautious in markets. And that's where we are at the moment. We're in that Q1 period and we need to be thinking about this. Could the markets rally further? This one's for the bulls. Even during bad times, we've seen that when the Fed is hiking and hitting terminal rates, which are these flat rates here in the past, we actually have seen gains in markets. It's the pivot that we need to be most concerned about. And just remember this, if the pivot happens in the future and you're not watching this channel or wherever you are in the world, just remember that when the pivot tends to occur, markets actually drop. Now, if no one believes that at the time, it will probably even be more likely that it occurs like that. Around 1/3 to 2/3 of the way through the cutting cycle is when markets have tended to drop to their lows, and then we've seen shifts to the bullish side. Qs tend to start first as well. So that means that the Nasdaq tends to pull us off the bottom before anything else does. And then the S&P 500 may make a new low after that, then start recovering. It's the same here with when we have inversion. We know that over 50% of all the bond yields are inverted. It's way higher than that now. So when the Fed pivots, we need to be concerned for the markets. So could there still be rallies? Absolutely. And I'm about to show you today what are some of the potential bull cases, and of course continue with these bear ideas. Forward PE ratios, well, we know what's going on with forward PE ratios. Recently, things have upticked, but it's been mostly in those kind of bigger mega caps that we've seen really still very, very high valuations. If you're interested in some of these things, I do share them over on Twitter. You can see here I've shared both the expected options moves for the week ahead and also the forward PE throughout, of course, the earnings period. And this is when it switches the most. We're going through changes because, of course, the big economists out there in the world as a whole are figuring out where they think stocks will be over the next 12 to 18 months. So here are some of the readings, and you'll notice we're still above that average over time, which is 16.82. So make sure to follow at FX Evolution if you're interested in some of those things. Let's move over now to the week ahead. We're still in earnings, and we know that earnings brings us some potential opportunities as traders. These are the implied volatility moves based on options market. You can see coin over here on Tuesday. Wow, that's a 16% expected move. We've got Teladoc, Unity, and Lucid. I know a lot of you in the community like these types of things. Again, huge potential gains and losses to be made during those earnings reports. So be aware of what the market expects so you know the real risks when you're about to go in there. And this is a great economic calendar. It gives you that visual representation, but also the options market representation, which is excellent. So just before we jump into the charts, we look at all the key levels, the expected options moves for all the specific stocks and all of that great stuff. I'd like to say the thank you to the sponsor of today's video, which is Tiger Brokers. Now, Tiger Brokers offers a whole bunch of premium stuff here, but let's have a look at some of the stuff they're doing inside their applications. So one of the things that I love about Tiger Brokers has always been their attention to upgrades. And this is one of my favorite upgrades ever, the option screener within the application display. It's as simple as going to quotes within your application of Tiger Brokers and then loading up the screener. From here, you can select the market that you're interested or potentially the underlying symbol, and also select some parameters that you might be searching for. Let's say we want to know some well-traded volume over the last couple of days. We can select that, and you'll notice it gives you 379 results. So when we've decided that we've found one we like, such as Apple here, we can click into that. Then we'll be given even further details to what we could be doing. We've got level 1 and level 2 data if you subscribe for level 2. And we also have prices, volumes, other bits of information, as well as price forecasts that come up in here, and implied volatility curves over time. So you can see that these improvements really can make a difference to your trading and investment journey. If you're interested in Tiger Brokers, check out the links in the description down below today. And of course, there's some extra ones that I've managed to organize for members of the FX Evolution community. All right, well, let's get into the charts. We'll start here with the VIX. Not much to report. I've still got the watch reaction level, so certainly something you may want to put on your charts. But let's go over to yields, because this is the story at the moment, at least the most pressing story. A new weekly breakout for yields. This is the terminal rate. So it means where will the Fed get to in terms of highest interest rate during 2023? At the moment, it looks like it's going on 5.3%, and some of the Fed board and other members are saying it could go upwards of 6%. If they get it to that eventuation, stocks will decline. You would think it's a pretty big problem, and stock market will not like that. They're calling the Fed's bluff at this point. Have we seen a new rise in 2-year yields? Not yet. If we do, expect that to also be a bit of a negative catalyst. Having alerts above these levels can be helpful because you may forget about this chart. So always remember, keep them on there. And also check out the US 10-year as well, which just spiked to a new high. And if that closes above this rejection over here, again, it could be a significant thing for the markets moving forward. Always want to be checking those US 10 years, 2 years, and terminal rates. So what happened with the slight declines we saw on Friday of yields, where basically we saw yields slightly go down, but at the same time, we had, of course, things like treasuries going up. Why? Well, if yields go down, treasuries usually go up. And this hit into a very key level. Treasuries we do like, and this is a very big zone for treasuries. They've been a crowded trade during 2023, but usually during crashes, deflationary busts, those types of periods, treasury bonds, especially when we're getting closer to the interest rate hike period, maybe get tapping off, should do okay. If you believe interest rates are going to 6 or 7% though, treasuries will suffer during that period. So you've got to time this really well with, more importantly, where the terminal interest rate is and how many cuts are expected in the future. So that forward projection, very important for treasury bonds and investors out there. What about high yields? Well, we've got similar warning signs that we had during 2023. High yields have started to drop, and the market is remaining resilient. If this continues and we continue to see high yields drop off, it becomes even more clear that something's wrong with the stock market. And over the medium term, that is the next 1 to 3 months, there's probably something bad about to occur. So remember, high yields will be watched. We'll keep watching them here on the channel and following it as much as possible. Let's begin with our dollar index discussion. So we've been pretty bullish on the DXY, and we've been talking about quite a few key levels and key zones into the future. Now, the dollar index did some interesting things last week. First and foremost, it managed to break out super aggressively during the news, especially after the PPI. Now, we haven't hit into our super critical zones here, which is that 105.25, which is a key zone we think to go to, but it has been in predominantly a bullish trend. Now, did that change as of Friday? So we led up, we bulled out, which is very big, but notice this level, it's super annoying. Every single daily close has remained underneath this zone. And with a rejection like that, you do need to start thinking about, well, is this telling me that the DXY is moving towards the negative side? We don't know that yet, but it has been incredibly resilient on this level. So I'm looking for a bullish close above this 103.85. And at the moment, you're really looking at smaller time frame scalps and movements through there. Have we got any buy zones or sell zones moving forward for the week ahead? Not yet. We need to find more information. That daily close was annoying for this one, so be a little bit careful out there. It's in what I would call a super critical zone. And I think a lot of buyers will try to come in here, but we've got to just think about how it reacts to some of these green boxes below. If I was trying to pick where the demand is, where the buyers sit, I believe they sit somewhere around that 103.50 in terms of the larger money at this stage. And of course, then down in these 103.15s. You can also check something like a fixed range volume profile on top of this, and you'll notice the most traded level sits down these levels, and also the value area high is where it is right now. Let's move over to gold. Is this good for gold or bad? Well, it's not too bad if the dollar index continues to weaken. Notice where gold's come back to. So we've got a low, we've got a high, we have a lower low. Do we make a higher high? If we do, pullback should be met by short-term time frame demand. Now, did gold get as low as we'd hoped? Well, it broke to a new low. The trend is still down, so don't discount that. You've got things like trend lines coming through. So it's an absolute critical zone here leading into the Monday futures option. And then, of course, the Tuesday for the stock market stuff. And we still know that gold is theoretically going in the downward space at this point. If yields continue to rise, I expect gold to continue to suffer. It's very, very, very bad if yields continue to go up. Gold doesn't like that, and it just makes sense. It's the oldest currency in the world, but if you have an increase in rates, what would I rather own? DXY. I'd rather own the US dollar over gold if I'm going to be able to get more in the bank for it. So just remember, it is all very sensitive to yields, and gold at this stage is at super critical zones. We break through that 1845, we could be looking at pullbacks being met with short-term time frame bullishness into prices such as 1870. I think this will be an interesting Monday, Tuesday futures market. Let's now move over to some other things. We'll actually load up copper here and have a look at it on the chart. Copper has been relatively weak recently. We've been talking a lot about this. It hit the trend line. We did end up seeing a pretty decent weekly buying kind of at the end. And obviously we got that new low. I'm a little concerned for copper here. If you were short up in the zones that we discussed, this would be where you would maybe reduce part of your short. And the only reason technically that you would do such a thing is because if you have a look down here, it breached this area and wasn't able to hold the low through the Friday session. So that means that this could have been a liquidity trap and effectively pushing the next levels for copper. I'm still negative overall on copper, but yeah, when you look at these technicals, if I was looking at it in a normal market, I would consider that this was a relatively bullish trend end, and we need to see more. Like if you want to go re-negative on copper, well, you need it to make a lower low underneath here, swing, and then allow you to go into the short. We'll continue to follow it, and of course, I'll be paying a lot of attention. US oil still stuck within the two ranges, not much to update there. Let's move over to natural gas, which took the low. So this is super important. This actually took the low. We suspected this would occur. Now I want to know what the reaction is to this. So a lot of people tried to buy natty gas here. I've warned against it many, many times because it's such a massive drop. Massive drops don't tend to be reversed instantaneously without pullbacks or some kind of an accumulation. So it hit these levels. That's good. You can see this critical zone and also this previous structure. I'm very, very interested to how it reacts here. So we'll be following natural gas, but we're still looking at it as a potential accumulation. If it starts to rally and we bust these highs, then we can say, okay, then we know there's a great chance that natural gas has actually started to bottom. Let's move over to, I would say, suspect number one of the markets, which has to be, of course, Tesla. You bulls out there in the chat, you just keep pushing this thing higher. There was a lot of options manipulation on this one leading into the biggest options manipulation period. But we've basically got through extreme zone 1. We also came back and retested my extreme zone, and that then was met by bullish demand. Do we have weakness here? Well, a lot of the bulls, they're drawing these types of trend lines and saying, look at this thing going up. I think that you'll need to breach below here to really start the negativity, but there is something bad in Tesla, and at some point it will break. Will it hit our extreme next two levels? I'm not sure yet. The trend still remains up in this case, and we didn't see at least enough reactions to the downside just yet. This reminds me a lot of the other squeezes we've seen in the past that got ridiculous, such as AMD. How did that end? Badly. It went down badly, but you also don't want to be on the wrong side of it over the short time frames. So at the moment, these trend lines, the weekly close, everything about Tesla smells of retail traders absolutely stackpiling. So you've got to be careful. If you're going to take shorts, maybe use options, maybe use a little bit more time. Think about the risks involved. Extreme level 2 is coming, and guess what? Expected weekly options highs are in extreme level number 2. That's around that 230, 235. For the low traders, if you're looking for potential buys and stronger positionals, well, we know where the expected weekly options low is, and guess what? It's right in those demand zones. So some key critical levels here for Tesla, but at the moment, this trend seems to be semi-intact Be careful, use the S&P 500 in conjunction. Let's have a look at the options. This is where retail traders keep buying. Look at them, they're stacking 200. You guys are stacking 200, 210, 220s. Some mad cat over here with 360. It's wild. It's some serious calls that are starting to flow through from retail here. I don't know who this person is. They're going to lose their money. But overall, this is the fight zone between that 200, 230 period. If Wall Street decide that they want to go against, they will. But at this point, the overwhelming power is in the retail calls. And that's why it's one of the toughest stocks at the moment to trade. Have a look at something like Nvidia. It's a totally different story at this stage. We'll move over to Apple. Here are the weekly expected highs and lows. Notice the low sits right on the low of the previous week before last week. Interesting. Options in highs are back in these kind of wick zones as well. Very interesting. I love the extreme zones for Apple this week, but I more importantly love the wicks. So the wicks are starting to show us that potentially this could be a turnaround. Now, if you're feeling super bullish, if it wipes and closes above these highs, wow, it could keep going quite hard. Critical zone. We've known that for a couple of weeks now. Look at Nvidia, another one. That's a horrible looking weekly options close or weekly market close as well. New lows. Maybe set alerts down in those areas. We'll update this with some expected moves as we lead through the week, but that's a nasty looking double rejection week. And they tend to usually have some follow through on them. If you notice some of the other ones we've had over here, there's been follow through. It doesn't mean it's going to go really low, but it's in an extreme zone, and Nvidia is certainly showing some of the signs. What about some other markets around the world? Here's the ASX 200. I've warned against this supply for a few weeks. We got an engulf, we got a follow through. I don't really see any support for the ASX 200 at this point, the XJO. It's continuing to fall. Some people will say 17,300 could be, where people buy the dip. But overall, I'm still seeing quite a lot of weakness here. And more importantly, I'm going towards those 7150s and even these kind of green boxes down here. If copper does start to fail again, and we see oil going down as well, and financial conditions starting to get worse for the banks, this is the triple trifecta for that. So if it's like, think about it this way. Everyone loves S&P 500 and Nasdaq on this channel. I understand Tesla, etc. But if you want to target certain sectors, then there are also other markets in the world, such as the XJO. This is a three-pronged market: materials, energy, financials. If those are all going bad, this thing will get absolutely smashed. So just remember that's something that's very important to note when you're thinking about analysis and where you're going to get the best rewards for your idea or concept. It's not always just S&P 500 and Nasdaq. CQQQ Chinese market continues to weaken. Notice how this has fallen off pretty considerably since we first reported on it. Up in here, talking about 10% down, it's not too bad. So it's continuing to look horrible. The Dow, it's a doji fest. Weekly doji, weekly doji, weekly doji. It's happy at its current zone. It's waiting for the breakout to give us hopefully some form of direction. And then what we can see is hopefully something like that occurring, or possibly even the buy side. But we do need to see this breakout. No breakout, getting close to the end of our triangle, something we will be watching. Here are the expected weekly options highs and lows for the Qs. Notice where the high is, back in these wick levels, these extreme zones. This is now 1, 2, and 3 weekly rejection wicks, and it does point towards potential rallies being met with selling demand, and that's something that we want to discuss. These are not quite the absolute break of the market, but certainly some weekly rejections. Nasdaq, let's move over to that one. Firstly, let's load up the weekly of the futures. Again, you can see those weekly rejections. Let's now go the 2-hour. So 2-hour pretty much worked perfect. It came straight into this demand zone and bought up through it, bought up through those close levels. Look at that beautiful buying through the Friday, came in super red and worked pretty much the way we thought, which was buyers coming off the SPY lows. Now, the Nasdaq's great, and I don't mind trading it, but let's have a look at the S&P 500 to get some of the better levels and then potentially come back over to it. So we've got here weekly rejections. Again, all of the unfilled gaps. I put them all here on the chart so you guys can see it. Notice some of these. Unfilled gap, 41.48. Weekly technical gap, 41.63. So that's in that supply zone range. People will lose their minds if it gets back up in here. And then we've got the 4018 as well as a technical gap. So remember 4018 and these two up here, they'll be very critical levels. The SPY, let's look at the expected weekly options ranges. Notice where the high is, 414. Wow. Coincidence? Probably not. 400 for the expected weekly options low. We were just talking about 402s and the demand down here. Coincidence? Probably not. Expected options highs and lows meet up really nicely with resistance and support levels this week. And then we move over to the futures market, and this played the game. I mean, it couldn't have got better. It took the low as we thought it may. It then rallied, and it's actually showing some potential bullish pressure here into maybe the real market opens. So we've got a couple of key levels. This zone here, which is 4087, we could see some sellers come in there. But I'm actually liking the idea that markets may retrace a little bit deeper, getting back up into these kind of 4120 zones. I think this area in here is quite interesting. There's a few reasons why I like it. So I'm going to put up 4120 as a key resistance area for where the bears may return, 4087 as a minor, and then where the bullers or the big bulls will be, I think it's pretty stacked towards that 400, 420 zone. So the big bulls will be floating around in this previous demand. And the bears, I'm hoping it kind of goes like this. That would be the best. That would be kind of cool if that did occur. Just because it makes a lot of sense with what the markets are doing. If anyone ever doubted maximum pain, then don't doubt it anymore. It got very damn close. 405 was expected. 407 was where the market reached. They made so much money. Wall Street absolutely destroyed us. They destroyed us, guys, as retail traders. So you have to be paying attention to the options market. Subscribe to the channel if you're interested in that. You know, this is where we get into it. It's a big, long video today, but there's so much to discuss. So I get excited about this stuff because it's great when you start to see the options market doing the things that you think and you trading with your technical systems to give you edge and you're stacking it. And it's a beautiful thing, the complements that you can build. So where are the puts? Well, retail traders keep buying puts. So it's hard for markets to decline. And that's why bulls have been winning so much recently. So look at this. The puts are just stacked all over those 395, 400 levels. And again, it builds up that kind of storyline that even if we do sell off, we're going to face struggles getting through here. It's nowhere near the amount of size, but when you scroll through to March and you look at, I think it's March 17th, which is the big options expiration, there's still tons of puts. So it's going to be very difficult for markets to go down a huge amount more. And that's why, even though we've given out temporary kind of levels, I still think it's possible, even though this is ridiculous, that the markets could still decline, do all this kangaroo stuff, and maybe get to 4,300 or even 4,350, and that to be the super critical zone. And that's mostly because there's still a lot of option puts in the system. So you gotta be careful out there, guys. Let's move over to Bitcoin. And Bitcoin is at a critical kind of turn level. We saw the strong reaction off here. We saw it bust underneath. It's pulled back. You've seen this big wick. It's kind of hovering. I'd like to see Bitcoin find immediate weakness. But if it breaches this and closes, get ready for Bitcoin to have a little bit of a ramp. And that could push us to next levels. We got the exact reaction we wanted. At the moment, there's weakness here. But if it's going to the next levels, you know, you're talking 30,000 basically for crypto and Bitcoin. So this is the next huge zone, this 30,000 zone. So very critical week to watch. And at the moment, stocks could boom a little bit, then bust, and then possibly rally. So we've got to be very open to these. Even though our medium term, that is the next kind of 6 to 9 months, we're feeling the markets will move lower. It's the stupid puts in the system that don't allow it to do it as easily. So it kind of ruins some of that ability. Let's move forward and have a look at the market. So of course we've got bank holidays on Monday, which means the market's doing its thing. And then we basically move through to the week ahead. Now, Flash Services PMI is coming out Tuesday 21st, New York 9:45. Then as we scroll down, we've got the FOMC meeting minutes. Oh yay, so much fun there. 2 p.m. in the afternoon. That may move markets quite a lot. Prelim GDP doesn't tend to move markets, but you never know. And then we've got the core PCE price index, 8:30 a.m. Friday, Feb 24th. So it's not like there isn't news this week. There certainly is. There's still options manipulation. And I think it's a great week to see some really good key levels being hit. If you're interested in finding out more about things on the fly as they happen live, remember to follow at FX Evolution. Subscribe here on the channel, guys. I'm excited for the next couple of months. I think this next 12 months could be the most exciting period in stock markets. Super interesting. I'm just loving it just because I think there's so much opportunity. And if you're interested in finding out more about opportunities, follow us over on TikTok, get that thing started so we can get pushing some videos out there. Twitter, join our exclusive group if you're interested, and anything else. Also, a quick reminder as well that Tiger Brokers obviously have a special offer at the moment for many members in the community. Check them out. Links in the description if you're interested in their app and some of the features that you might be able to get as a trader or an investor that could help you to potentially gain edge in markets. Catch ya. See you in the next one.